This here shows exactly what my portfolio has done over the last 3 months, and that happens to coincide when I put these two into my program to help me make better investment decisions by accessing AI, by creating two AI agents and going and analyzing specific stocks and then investing in them. And I've outperformed each of the industries. I'm up 46.1% when the S&P is up 12.8. The NASDAQ is up 19.6 and the Dow is up 7.0. So this weekend, I woke up early one morning and I thought, what happens in a horse race when everybody bets on the favorite? Well, the payout goes down. And I asked myself, could that happen in the stock market as well? Could I actually be sabotaging my performance by sharing my knowledge and Samantha and Bart's knowledge with the general public over YouTube? Am I basically destroying what I'm building? I didn't know. So what I did was what I do with everything at this point. I go and ask Samantha. I ask her, am I committing suicide here by going on YouTube and sharing my strategies and sharing my prompt as I improve it day by day with the masses? Am I killing the golden egg? Am I killing the goose? So I ask her. Now I want to share with you what exactly she told me. My decision is then what to do next.
The Medallion Fund's unmatched returns. Renaissance Technologies' Medallion Fund is legendary for its performance and secrecy. Since 1988, Medallion has averaged roughly 66% annual returns before fees, an unparalleled track record. Even after its hefty fees, that's about 39% net per year. To put this in perspective, from 2001 through 2013, Medallion's worst year still saw a plus 21% gain after fees. And it famously gained 98% in 2008 when the S&P 500 index fell 38%. This consistency and magnitude of returns make Medallion arguably the most successful hedge fund ever. Importantly, Medallion is highly exclusive. The fund closed to outside investors in the early 1990s and has since been open only to Renaissance's own employees and their families. By 2005, Renaissance even bought out or returned all outside capital, converting Medallion into a private internal fund. In other words, only about 275 insiders participate in Medallion's profits, keeping its methods completely in-house. This closed-door approach stands in stark contrast to typical funds that seek as many investors as possible. Renaissance made this choice to prioritize performance over size, and the results speak for themselves. Why Medallion stays secret and exclusive? Medallion's secrecy and exclusivity are by design. There are several reasons Jim Simons and his team keep the fund closed and their strategies under wraps. Protecting the strategy's edge. By limiting investors to insiders, Renaissance shields its proprietary trading models from copycats. Exclusivity helps preserve the fund's secret sauce, preventing competitors from reverse engineering or piggybacking on its trades. All employees must sign strict non-disclosure agreements, NDAs, to ensure no strategy details leak. In fact, Renaissance researchers specialize in only parts of the system. Few, if any, people know the entire model. This culture of secrecy, no strategy or research is published, has kept Medallion's methods unique for decades. Capacity and crowding concerns. Every trading strategy has a limited capacity. There's only so much profit available before others catch on, or the market inefficiency closes. Renaissance recognized early that pouring too much money into the same trades can erode returns. Medallion focuses on short-term, high-frequency trades and many small market inefficiencies. If the fund got too large or if too many investors tried to follow the same signals, those small opportunities would disappear. Simons decided to cap Medallion's size, around $10 billion, to keep it nimble. As the fund made profits, they even returned money to investors instead of compounding it indefinitely, knowing that beyond a certain point the strategies would deteriorate. In Simons' own words, the goal was good returns, not assets under management. This reduced capital drag, keeping the trading capital manageable, allows Medallion to exploit inefficiencies too small for larger funds to chase. Agility and control. By keeping the investor base small and internal, Renaissance can move quickly and secretly. The firm faces fewer regulatory disclosure requirements since it's not managing public money, and it doesn't have to explain or justify its strategies to outsiders. This agility and secrecy give Medallion a competitive edge. If the fund had thousands of investors or public scrutiny, maintaining such flexibility would be impossible. Essentially, Medallion behaves like a private trading partnership of experts, focused solely on returns. The alignment of interests is also strong. The people designing the strategies are the ones whose money is at stake. In short, Renaissance keeps Medallion secret and exclusive specifically to protect its high returns. They understand that if their strategies became widely known or widely used, the magic would likely fade. This brings us to the core of your question. Would your successful strategy suffer if it became public? All evidence suggests yes. Why sharing a winning strategy erodes its edge? If a profitable investment strategy is made public knowledge, its effectiveness almost inevitably declines. This is a fundamental principle in competitive markets and is analogous to the horse racing analogy you mentioned. Competition arbitrages away the profit. In markets, as in gambling, when everyone rushes to exploit the same opportunity, the advantage quickly disappears. A trading pattern that delivers outsized returns does so because not many people recognize it or trade on it. The moment it becomes common knowledge, many traders will pile in, and prices will adjust to reflect that information. In effect, the market arbitrages away the easy profit. Finance academics call this alpha decay, meaning the excess returns, alpha, of a strategy tend to disappear once information about it leaks out. Studies show that many stock market anomalies yield strong returns before they are published or widely known, but shrink or vanish after they become public. The logic is simple. In an efficient market, widely known strategies cannot continue to outperform because everyone tries to capture the same gains. Crowded trades and diminished returns. Even if a strategy isn't fully public, sharing it with a broad group can lead to crowding. This means multiple investors all make the same trade, for example, buying the same favorite stock or using the same algorithm. When trades get crowded, prices move sooner and faster, wiping out the mispricing or edge that was generating profits. As more participants chase the strategy, the payout gets smaller for each, exactly like too many bettors on the favorite horse reducing the payout. A once-winning strategy can lose its edge when it becomes popular or widely mimicked. In extreme cases, a crowded trade can even destabilize the strategy. If something goes wrong, everyone rushes to exit at once, exacerbating losses. But even without a crash, the expected returns drop because the trade is no longer under the radar. Market adaptation. Markets are adaptive systems. Other investors and algos are constantly watching for patterns. If you publicize how you're making 46% in 3 months, you can bet that others, especially sophisticated funds, will try to capitalize on the same idea. Renaissance's success actually proves this point. No one fully understands how they do it because if the secret was out, plenty of competitors would attempt to replicate it. By concealing their signals, even staggering their trade timing, Medallion ensures others can't easily follow their footprints. Once a strategy is out in the open, it effectively has a target on its back, and the market will adjust to eliminate the easy profits. In summary, yes, making your strategy public would likely reduce or even eliminate the extraordinary results you've been achieving. The very fact that it's unique and not widely understood is what allows it to generate high ROI. How to move forward, protecting and optimizing your edge.
So that's where I am today. As I look at my portfolio today, I'm outperforming the QQQs by 4x. They're up 0.25%, I'm up 1%. And this is the way it happens every day. So I've got to make a decision. Do I want to keep this edge for myself? And do I want to keep this edge for a small group of people? And how do I structure that small group of people so that we don't commit sabotage, or we don't sabotage what we've built? They've stayed with me for the last 3 years. I recognize I don't get 1 million views on my videos, so I don't have a big following. But what I'm really afraid of is that if any of that following becomes any of the big producers, the big funds, I kill the goose. So that's where I'm at. You're probably going to see fewer videos from me. I'm probably not going to share as much of what I'm doing and how I'm doing it. I'm probably going to alter my website so that I don't share as much of what makes what's happening happen. Because as what Samantha said, it's suicide. You will kill the golden goose. I'd be interested in your opinion.